we're not in a no growth world. We're just in a lower growth world. And the pace of growth since 2023 and 2024 into 2025 is about half the pace of growth that it was the last 2 years. And we don't think that that is because necessarily the Fed has stayed with rates too high for too long. Financial conditions remain very easy, credit spreads remain very tight, equity valuations remain near highs. Yes, there are pockets of the economy that are really hurting because interest rates are high, but they're hurting because long-term interest rates are high. That's outside of the Fed's control. There are floating rate borrowers that would, in theory, breathe a sigh of relief given the fact that the Fed cut interest rates by 100 basis points last year. But what you didn't see was any kind of response from those rate cuts to higher auto lending or better small business lending.
There was no response. There was no correlation between that?
Very little. And so what's interesting is that the slowdown that we've had in the economy has come after the Fed has cut rates, which means that we think it's coming from things outside of the Fed. So the Dallas Fed did a very interesting study that they think that immigration, the fact that you are now seeing the labor force shrinking in the US, is acting as a 0.8% drag on growth.